Hey guys, and welcome to this YouTube channel. In this video, I'm going to show how to identify supply and demand zones, as well as how to trade from high probability ones. So first of all, what is supply and demand? In a downtrend example, a supply is basically an area where sellers stepped into the market and overpowered demand. Or in other words, it overpowered buyers. So as we can see, price went down, it went up, and then it went down. So at this point over here, where the market formed that lower high, sellers overpowered buyers and pushed price down to break structure. So after breaking this structure, we now have a valid supply zone to trade from. And then for an uptrend, it's the opposite. So we can see in an uptrend, we have a series of higher highs and higher lows. Where this higher low was formed, we have buyers overpowering sellers and pushing price up. So after breaking this high over here, we are then left with a valid demand zone that we can trade from. Now, a supply zone is basically going to be the last buy candle followed by a sell candle. So in this example, we can see that up here, we had a blue or a buy candle, which was then followed by a sell candle. So the bottom of this blue candle and the top of this blue candle is going to be our supply zone. And then for an uptrend, it's going to be the opposite. It's going to be the last sell candle followed by a bullish candle. And then we're going to draw the demand zone on the top of the bearish candle to the bottom of the bearish candle, like so. And this area here will be our demand zone. So the expectation in a downtrend is that after breaking this structure over here, price will then pull back into this supply zone where we expect sellers to push the market back down again and continue the downtrend. And then in the uptrend example, we expect a pullback into this area of demand where buyers can step in and push the price back up and continue the uptrend. Now, supply and demand zones are everywhere across all timeframes and across all markets. So now let's talk about what makes a supply or demand zone high probability to trade from. So there are 3 rules or criteria to make a demand or supply zone high probability. And the first one is that it caused a break of structure. So as we can see here in this example, price went up, pulled back, and it went higher, and we broke this high up here, giving us a break of structure. So then we have a valid demand zone over here that we can trade from. If we compare that to the illustration here on the right, we can see that price went up, it went down, and it's starting to go up, but it hasn't quite taken out this high. So now if price pulls back into this demand zone, there's a high chance it will fail because this low or this demand zone didn't actually lead to a break of structure. It didn't actually break this high. So therefore it's a weak low or a weak demand zone, and we do not want to be trading from that because it didn't break any structure. The next rule that makes a high probability supply or demand zone is that it has some bait or some liquidity resting nearby. So in this example, as price is pulling back, we notice that we have left these equal lows just above this demand zone over here. So whenever you see equal lows just above the demand zone, that actually makes this a very high probability demand zone that price will then come down, take out the stop losses, because as you can imagine, when we have equal lows, a lot of support and resistance traders will be placing their stop losses just below these lows over here. So then the market comes down, takes out everyone's stop losses, and then continues going higher. And that's why I call it bait, because we know a lot of people will be tempted to buy from here because they see that this double bottom is holding, or they see that this support level is holding, and they're going to fall for this bait and be sucked into buying and putting their stop losses below these lows. So we do not want to be bait. We do not want to also have our stop losses resting underneath these lows. Instead, we can identify that we have a valid demand zone over here. We're identifying that there's a double bottom resting just above the demand zone. So rather than buying over here and putting our stop losses with the masses, instead, we can look to buy from this demand zone over here and target this weak high as a minimum. And the third rule is that we only want to be trading from unmitigated supply or demand zones. And that is just a fancy way of saying, if price has hit the zone before, that means it's been mitigated. If the demand zone is fresh and price hasn't touched that zone before, that means it's unmitigated. So as we can see from this example, this was a valid demand zone, but price already came down, touched this zone, filled in those buy orders, and then it went higher. So that means we do not want to be trading from this zone anymore because price has already come down and touched it. Instead, we might have another demand zone over here somewhere. Because now the difference is that this demand zone over here hasn't been mitigated, so it's unmitigated, because as we can see, price came down, but it hasn't actually quite touched this demand zone. So this demand zone is still fresh, price hasn't touched it yet, So now when price pulls back, this is a good demand zone to trade from. And then finally, we do not want to be trading from weak supply or demand zones, or a weak high or a weak low. And what that means is that in this example, we can see that we're in an uptrend because the most recent break of structure happened over here, and we're making a series of higher highs and higher lows. So now when price is approaching this supply zone over here, because we have this buy candle followed by a sell candle, so as price is pushing up and hitting this supply zone, we do not want to be trading from this because this high hasn't actually led to a break of structure. Because all that's happened is price went down into an area of demand, and then now price is going back up. So we do not want to be trading up here as price is going up, because the expectation is that this uptrend will continue and take out this high over here. On the other hand, if this high did break structure, so as we can see in this example it did, because we have a break of structure over here, now this supply zone over here is safe to trade from. So when price pulls back up, now we can sell up here with confidence that price will respect this supply zone because it actually led to a break of structure. So it's a strong supply. So now let's look at some chart examples. So we can see here that we broke this high over here, giving us a break of structure. So because we broke structure, this is going to be our low down here. We now have a valid demand zone to trade from, and that's going to be this big sell candle over here, the big black candle. So this is our demand zone that we can trade from. Another good thing about this demand zone is that we have this double bottom or triple bottom formed just above the zone. Well, we know a lot of people would have their stop losses all resting underneath these lows over here. So these lows over here are going to end up being bait or liquidity for the market to come down, take out their stop losses, enter this demand zone over here, and then continue the trend in upwards direction. So this was a high probability demand zone because it led to a break of structure and we had double bottom resting just above the zone. So now moving on, we have another break of structure, which means that this is going to be our new low. We now have a valid demand zone to trade from, which is going to be this sell candle over here. So as price is pulling back, we can put an entry here, stop loss just below the low, and then target 3, 4, or 5R, or however much you want. What's even better is that as price is pulling back, we can see we have this double or triple bottom formed just above the zone. So that means it's going to be even more high probability to trade from, because we know a lot of people are going to have their stop losses all resting underneath these lows over here. And then as you can see, price has come down, taken out everyone's stop losses into this fresh unmitigated demand zone, and then the trend continues in the upwards direction. Now let's compare that to this. So we have a break of structure here. This is then going to be our low. But notice how there is no bait, there is no double bottom, there's nothing here in front of this demand zone. So the chances that this demand zone will hold is going to be a lot less compared to if price is pulling back and leaving some nice equal lows or liquidity just above the zone. We can also see that price is coming down with a lot of momentum. So usually when that happens, these demand zones end up failing. So as we can see, this demand zone ended up failing because there was no liquidity, there was no bait, there was nothing above the zone. The only thing this demand zone had is that it led to a break of structure, but that's it. Now, a lot of people make the mistake of thinking that this demand zone is a good demand zone to trade from. But this demand zone, it didn't actually lead to a break of structure because we can see that price is just creating a series of lower highs and lower lows. If price actually broke this high, then this demand zone would be a valid demand zone to trade from. But in this case, price just pulled back up into this supply zone over here. And the fact that it's a downtrend, we're expecting that this supply zone will hold and that price will continue lower. So because of that reason, we do not want to be trading from a weak demand zone or a weak low. So it's no surprise that this demand zone ended up failing because it didn't lead to a break of structure and we were a downtrend. So the expectation is that the trend will continue in the downwards direction. And here is another example. We can see that we're heavily bearish as we're making a series of lower highs and lower lows. Now, some people might think that price has broken this high over here, which is true. But if we look at the bigger swing trend, we can see that the swing high is all the way up here. So this little minor break is nothing. So now a lot of people would probably be looking at this demand zone down here and they're thinking, oh, it's a great area to trade from. But remember, market structure and the trend is always going to be the most important thing. So because our swing high is all the way here and price is just pulling back up, the expectation is that price will still continue going lower. So you don't want to be trading from a weak demand zone like this, because this low has not broken this high. Therefore, it's a weak low and a weak demand zone. And as you can see, it ended up failing and price pushed lower. So that's going to be it for this video. I hope you guys learned a lot about what makes a high probability supply or demand zone, and I hope that it's helped with your trading. Now, if you want to learn more about how this strategy works and how we fit in multiple time frame analysis, market structure, liquidity, supply and demand, and all the concepts together, I have a full course on Discord that you can join and be part of the Discord community. So the link for that is going to be in the description below. Otherwise, you can join the free Telegram channel where I'll be posting some analysis on AUD USD, Euro USD, and GBP USD. So that's going to be it for this video. Don't forget to like and subscribe, and I'll see you guys in the next video.